Good Zangpo, welcome to Bhutan e-learning project. This lesson is on rules on debit and credit for key stage 5 classes 11 to 12. The topics to be covered in these lessons are types of business activities, types of accounts, and the rules for debit and credit. The topics for this lesson are types of business activities, types of accounts, and rules for debit and credit. Lesson objectives. At the end of these lessons, the learners should be able to 1. Classify different categories of business activities. 2. Compare and contrast different business activities. 3. Apply the rules of debit and credit. 4. Compare and contrast traditional and modern approaches. Now, we'll discuss on the categories of business activities first. Business activities. We are going to come across different types of activities in any form of business, and therefore it's important to know what are the categories of business activities. We should also have clear knowledge about under which category the business event or transaction is falling. This guides us in preparing different financial statements. The business activities consist of first, financing activities. 2. Investing activity. 3. Operating activities. Now let us discuss each of these activities in detail. First one is financing activities, or it is also called as borrowing. One primary source of outside funds to the business are borrowings. Borrowing money from the financial institutions are called as debt money. The capital of the business can be financed by the financial institutions. So when the company borrows money from the financial institutions, it becomes borrowings. These amounts are owed to the financial institutions, and the financial institutions becomes the creditors of the company, and the amount is called as liabilities. And other forms of financing activities are notes payable and bonds payable. Another second primary source of outside funds in financing is issuing shares. Issuing shares or stock for cash is another source of finance to the business. Share capital is the amount paid by the shareholders for the shares they have purchased, and shareholders, we give them dividends. Second activity is called as investing activities. Investing activities are those activities which include purchase of resources of which a company needs to operate. 2. Resources owed by a business are called assets. Examples of investing activities are computers, delivery trucks, furniture, buildings, and investment in another company. If a company A buys the shares of company B, it falls under investing activities. Third one is operating activity. Operating activity begins once a business acquires asset. Revenues are generated. Amounts earned from the sale of products and other sources are called as revenue. Sales revenue, service revenue, interest revenue are some examples of operating activities. Inventory is an asset that consists of goods available for sale to the customers. Accounts receivable are the right to receive money from a customer as the result of sale. So these are examples of operating activities in a business. Other operating activities include expenses incurred to earn revenue. In these expenses, it can be cost of assets consumed or services used, or it can also include cost of goods sold, selling, marketing, administrative, interest, and other tax expenses. Operating activities includes liabilities arising from expenses like accounts payable, interest payable, wage payable, salaries, sales tax payable, or income tax payable. As a result, we get net income when revenue exceeds expenses, and we get net loss when expenses exceeds revenue. So these are three types of activities in any form of business or a company. student activity. Here, dear students, you have to do this homework, do some research and find out why business activities are classified into 3 categories as mentioned above. I'm giving homework here to the students. Read carefully, do some research and find out why business activities are classified into 3 categories as mentioned above. Now, second part is on rules for debit and credit. It's on rules for debit and credit. Here, we are going to learn how we are going to debit and credit the accounts. So, financial accounts can be classified into 2 types of approaches. One, it's called as traditional approach. 2, it's called as modern approach. Now, let us study in detail about traditional approach first. In traditional approach, the accounts are classified into 2 broad categories. One as personal account, 2 as impersonal account. And this again is further classified as natural person in personal account and artificial person in personal account. Natural persons are like you and me, who can speak, who can listen, who can understand a sector. Second category of personal account is artificial persons like Bank of Bhutan, like Tashi Bank, who has a separate legal entity, who can be sued and who can sue the other companies to the court. Now, examples of natural persons account can be PEMAS account, proprietor's account, and examples of artificial persons can be company's account, bank account, etc. And in second approach, called as impersonal accounts. In impersonal accounts, again, it is further divided into 2 categories. 1, real account, 2, nominal account. Real accounts are the accounts of assets and nominal accounts are the accounts of expenses, losses, incomes and gains. This is also called as a golden rule of accounting. For a traditional approach, we also call it as golden rule of accounting. So basically, there are 3 golden rules of accounting in traditional approach: personal account, real account and nominal account. We categorize broadly into these 3 types of accounts, and then we debit and credit accounts respectively. For example, in personal account, we debit the receiver and then we credit the giver. I repeat, in personal account, we debit the receiver and credit the giver. In real account, we debit what comes in and we credit what goes out. I repeat, in real account, we debit what comes in and we credit what goes out. For a nominal account, we debit all expenses and losses and we credit all incomes and gains. Now, in order to understand these rules, let us first discuss and see one business scenario. Analyze the transaction based on the traditional approach of accounting. State which accounts can be debited and credited. This is business scenario for you. Mr. Tashi invested 100,000 Nultram and started a wholesale business for organic vegetables produced from Dagana. His shop is located in Thimphu, anticipating the huge percentage of population not practicing vegetable farming to be his targeted customer. He purchased furniture worth 10,000 to be used in his shop in Thimphu. Then he purchased vegetables worth 50,000 from a group of farmers from Dujigang, Dagana, making cash payment. He also went to Tashiding village and purchased 700 kgs of green chilies at 7,000 from Abdoji on credit. He sold all the vegetables at 100,000. He paid 7,500 as salary to his salesperson, and his rent were outstanding for a month 13,000. So students, focus on the yellow highlighted part, and let us take this and learn how to debit and credit these transactions. Students, focus on the yellow highlighted words. Then you try to copy this down. Then we will analyze how to debit and credit these transactions. analyze any transaction, it's important to know what is the accounts involved, nature of accounts involved, how accounts are credited, and then we have to see if that particular transaction is debited or credited. Number one, does she invested capital? So the transaction here involves cash and capital, and then this cash and capital has to be categorized according to the three golden rules, whether it is real, whether it is nominal, or if it is a personal account. So first, cash is a real account. So therefore, in a real account, debit what comes in, credit what goes out. So cash is coming in the business, therefore it is debited. So capital account is a personal account. So therefore, in a personal account, credit is the giver and debit is the receiver. Here, the capital is being introduced into the business and the karma is giving this capital into the business. So karma is the giver. Therefore, the personal account of capital is credited here. Transaction 2, he purchased furniture. So furniture is a real account and cash is also a real account. Now furniture is coming in the business, therefore in a real account, rule says debit what comes in, credit what goes out. Therefore furniture is debited and cash is credited. Transaction 3, he also purchased vegetables. So vegetable is again, purchases is again real account because vegetable is coming in. Therefore, purchases will be debited. Here he pays cash to the group of farmers. So cash is going out. Cash is real account. So cash has to be credited. So cash is credited for the third transaction. Now fourth transaction, he purchases vegetables from Abdoji on credit. Now here purchases like in the previous transaction, it is a real account. Vegetable is coming into the business, it has to be debited. Then Abdoji, his name is reflected here because Abdoji is a personal account. He is giving vegetable to our firm, vegetable to Karma's shop. So therefore, credit the giver. In a personal account, credit the giver, debit the receiver rule apply here. Fifth transaction, he sells his vegetables now. So when he sells the vegetable, cash comes in and the vegetable has to go out. Therefore, following the rule of real account, it says debit what comes in, credit what goes out. Subsequently, we have debited cash and credited sales account. Sixth transaction, he is paying salary to his employee, salesperson of 7,500 a month. So salary account is a nominal account. It's expenses on the business part. So on the basis of nominal account, all expenses and losses are debited. Therefore, this salary is an expense, thus it is debited accordingly and cash is going out here. So in the real account, credit what goes out. So cash account has been credited. Now seventh transaction, the rent is outstanding. The shopkeeper did not pay the rent for a month. Therefore, rent is a nominal account because rent is an expense. Therefore, expenses are debited. Then other corresponding entry is rent outstanding account. Rent outstanding account is a representative personal account because this has to be given to the landlord at the end of every month. Thus, landlord becomes creditors of the firm. So therefore, rent outstanding account should be credited and the rent account should be debited. This is how we analyze the transaction and then apply rule for debit and credit. Next one, second approach is called as modern approach. If you look here, you can see in the modern approach, the accounts are broadly categorized into five types or five categories. They are assets, liabilities, capital, expenses and revenue. Modern approach, I think it has emerged because of the improvement in technology. The account has to be put into the softwares. They have to develop software for accounting. Therefore, computer do not understand personal, real or nominal because they do not have artificial artificial intelligence to make that kind of distinctions. However, computer functions on plus and minus. So modern approach, I believe it has come because of the application of technology in accounting. Now, in these 5 categories, if you look carefully, it is simply the accounting equation which says assets are equals to liabilities plus shareholders' equity. Shareholders' equity can be further divided, and it can be divided into expenses and revenue. Now, if you look at asset, the assets consist of land, furniture, equipment. Then liability consists of bank loan, accounts payable, outstanding expenses. Capital consists of share capital. Then revenue consists of sales revenue, and expenses consist of rent paid, salaries paid, fuel charge paid, etc. So these are 5 broad categories of accounting heads under modern approach. So again, we will discuss how this rule is being used for debiting and crediting the accounts. This modern approach is also called as 5-diamond rules, or it is adopted from accounting equation. So accounting equation says assets are always equal to liability plus capital plus revenue minus expenses. Now, how are you going to debit now? Here, if you look at the arrows, there are 2 different types of arrows. You can see red arrows and green arrows. Now, arrow is sometimes pointing out, sometimes pointing downward, which means if it is green and pointing upward, it is called as increased. And if arrow is red and if it is pointing downward, it is called as decreased. Now, here the 5-diamond rule says when there is increase in asset, it has to be debited, and when there is increase in expenses, it has to be debited. So when there is increase in liability, capital and revenue, it has to be credited. So there are 5 increases: increase in assets debited, increase in expenses debited, increase in liability, increase in capital, increase in revenue are credited. On the other hand, when there is decrease in liability, decrease in capital, decrease in revenue, it is debited. And then when there is decrease in asset, it is credited. If you look at the accounts head separately, it has the opposite effect. Asset increase is debited, decrease is credited. Liability decreased is debited, and liability increase is credited. Likewise, you can read for all other account heads. Now, jumping back to the business scenario that we have already learned in a few slides back, we are going to analyze this transaction again once more using modern approach. We have to focus on the same transactions on yellow highlighted part and then use modern approach to debit and credit all these transactions. So let's see how we are going to use rules to debit and credit the accounts in modern method. So we have accounts involved, nature of accounts involved, how accounts are debited, debit or credit. So first transaction, again, investment of capital by the proprietor. He brings in cash. When he brings in cash, it is an asset as per the accounting equation. So cash is increased in the business. Therefore, when there is increase in the asset, it is debited. Second part is capital account. A capital account falls under capital category. So when there is increase in capital, it is credited. So here asset increase debit, capital increase credit. If you look carefully here, these are 2 will be on different side of accounting equation. Cash will be on asset side, capital will be on the other part of the equation. Therefore, when you have one increase in asset here on the left hand side, there will be increase in liability or shareholders equity or capital on the right hand side. Therefore, cash account asset it is an asset, it is increased. Capital account, it is capital, and capital is increased. We have credited that one. Second transaction is furniture, purchasing of furniture. Furniture is an asset, asset is increasing in the business, therefore it is debited. Cash is going out, cash is an asset. When there is decrease in asset, it is credited. Third transaction, purchased inventory. He has purchased inventory. Now he has purchased here, he has purchased vegetables. Now when he purchased vegetable, purchases are expense. Purchases are expense. If there is increase in the expenses, we debit it. Here, other part of the transaction is cash is going out. When you buy vegetable, you have to pay cash. Cash is another asset here. So asset is getting decreased, therefore decrease in assets are credited. Next one, again purchase goods from Abdoji on credit. What happens? Purchases is expense. In expense, when there is increase in expense, it is debited. And Abdoji, to whom you owe money now, because you have purchased on credit today, you have to pay him on later date. So the liability has been occurred. Liability has to be recognized here. So money to be paid to Abdoji becomes a liability of the firm. When there is increase in liability, it is credited. Fifth transaction is sales transaction. He gets cash. The shopkeeper gets cash. Cash is asset. Asset gets increase. When there is increase in assets, it is debited. Then sales account is a revenue account. When there is increase in revenue, it is credited. Then we have 6, salary account. Salary is an expense. We have to debit as expense is increased. We have to credit cash because there is decrease in the asset. 7, outstanding rent. Rent and outstanding rent. Rent is expense account. Expense has increased. When there is increase in an expense, we have to debit it. Then you have an outstanding rent. This becomes a liability. Liability has increased and thus it is credited. So this is how we apply the modern approach of accounting to classify to debit and credit respective transactions. Now let us try to summarize the modern approach. If you look carefully, you can summarize modern approach like this now. First one is asset. When there is increase in assets, it will be debited. When there is decrease in asset, it will be credited. Then expenses. When there is increase in expenses, it will be debited. When there is decrease in expenses, it will be credited. So the normal balances of these accounts are debit balance, meaning the balances of assets and expenses normally will have debit balance. Therefore, the normal balance in a blue color is written on the debit column side here. I repeat, for the accounts like assets and expenses, the normal balances will be always debit balance. I have here some helpful hint. The normal balance is the side where increase in the accounts are recorded. I repeat, helpful hint for you all. The normal balance is the side where increase in the accounts are recorded. Next part is liabilities, equities and revenue. So when there is increase in liability, it will be credited. When there is increase in equity, it will be credited. When there is increase in revenue, it will be credited. For debit entry, there should be decrease in all these 3 types of accounts. So here, if you look at the red letters as normal balances, it is on the credit side. It is on the credit side, meaning these types of accounts normally will have credit balance. I'm repeating, this type of accounts like liabilities, equities, capital or revenue normally will have credit balance. Normally will have credit balance. Now let's do some revision and close our lesson for today. Get ready, it's a quiz, student, it's a quiz. Review question 1. Which transaction will have debit effect? Increase both assets and liabilities, decrease both assets and liabilities, increase assets and decrease liabilities, decrease assets and increase liabilities. Which transaction will have debit effect? From the 4 transactions given below, which transaction will have debit effect? So, the transaction increase assets and decrease liabilities will have debit balances of account. Next question, question number 2. Accounts that normally have a debit balances are A. Assets, expenses and revenues. B. Assets, expenses and equity. C. Assets, liabilities and dividends. And finally D. Assets, dividends and expenses. So, I am asking which of these 4 options normally will have debit balance? So, amongst these 4, the last option, the assets, the dividends and expenses will have debit balance. Thank you and see you in my next lesson.